Welcome again to my channel, where I translate technical accounting lessons to a storytelling version, sort of. Now, in the past episode, we had this illustrative problem, and I asked you about the accounting of this illustrative problem, right? Now, because of that, we completed this timeline and we made these journal entries. Now, again, if you have these entries and you already have completed the timeline like this, you can already answer all the possible questions related to notes payable accounting. So I'm going to dedicate my time in this video to presenting all those possible questions and answering how to answer them. Okay? So for example, possible question number 1. You can be asked about what is the effective rate. And since we already have computed it to be 11%, based on supposedly the results of our trial and error and interpolation, there is already no problem with answering this question number 1. So question number 2, you can also be asked about what is the initial valuation of the notes payable. Well, in this particular illustrative problem, the initial valuation of the notes payable is the cash price, right? So it has been made readily available. So that's it for question 1 and question number 2. But before we go to the question number 3, related to this question number 1 and 2, let me add something. Let me tell you that sometimes the effective rate is given. And if that's the case, you don't need to do already an interpolation and trial and error. So what will you do? You just have to use the rate, the effective rate that was given, in getting the present value of these payments. So for example, if we are talking about this problem, if 11% was given as the effective rate, then you just have to multiply this 400,000 in the first year with 1.11 raised to the power of negative 1. And the second payment will be multiplied with 1.11 raised to the power of negative 2. And this 330,000, the last payment, will be multiplied to with 1.11 raised to the power of negative 3. Now, if you are going to simplify those, then you are going to get the present values of these payments. And you need to add them up and you will get the present value even if the amount is not given. So meaning, you will get this 986,000 plus. Okay? So that's it for possible question number 1 and possible question number 2. Another possible question is, what is the carrying amount of the notes payable in the subsequent dates? Well, you just have to focus on the carrying amounts in your timeline. If you are using the timeline, or if you're using amortization table, you need to focus on the carrying amounts, like these amounts. Okay? And that's it for possible question number 3. Now, possible question number 4 is, what is the interest expense for a specific year? Well, if you have a timeline, you can just compare the after interest amounts with the before interest amounts. Like the interest expense in this illustrative problem for year 1, it can be extracted by deducting this before interest amount of 983,116 from this after interest amounts of 1,091,259. And again, the difference is 108,143, which can also be extracted from this journal entry. Okay? So the same pattern can be applied to get the interest expense in years 2 and years 3. So again, let me repeat. It's after interest amounts minus the before interest amounts. Okay? Now, possible question number 5 is, how much is the interest payable? Now, let me be very clear. Interest expense is based on before and after interest amounts. And it is based on the effective rate, which is, in this problem, that's 11%. And as you can see, the reason why the after interest amounts and the before interest amounts has a difference, it's because of the effective rate. Okay? So, that's interest expense. The interest payable, on the other hand, is based not on the effective rate, but on the agreed rate or the nominal rate. Meaning, if we apply it in this problem, we are talking about this 10%. And if we wanted the amounts, we are talking about this 100,000, this 70,000, and this 30,000. Like for example, if Baby J paid 100,000 after December 31, 20x1, like for example, January 4, 20x2, the interest payable to be recognized at the end of 20x1 or December 31, 20x1 is 100,000, not this 108,143. Okay? So, see the difference? Again, the interest payable is based on the nominal rate or agreed rates, while interest expense is based on the effective rate. Okay? Now, there's another thing that you should remember, and that's sometimes interest payable is zero, especially if you paid the interest agreed upon at the end of the reporting period. Like for example, your company is following the calendar year. So your year end is every December 31. If your interest payment is also made in December 31, then expect that your interest payable is zero. Okay? And aside from that, sometimes the interest payable is zero if you did not agree on interest payments. Now, for example, in this illustrative problem, if this clause here is erased and all that's left are these principal payments of 300,000, 400,000, and another 300,000, then there will be no interest payable because in the very first place, you have not agreed to pay any interest. Okay? In short, if you only agreed to pay principal like these amounts, like in the case of non-interest bearing notes, actually specifically in the case of non-interest bearing notes, there will be no interest payable. So again, it's not the same with interest expense because interest expense will always be there if you incurred a debt or payable, regardless of whether there is an agreement on interest payments, just like in this problem, or even if you pay interest at the end of the reporting period or not, there is always an interest expense that should be recognized. Okay? Possible question number 6 is how much is the discount balance? Again, you can get that by comparing these carrying amounts here or the amortized cost versus the undiscounted principal balances. Like for example, at the beginning of year 1, the undiscounted principal debt is 1 million. So you need to compare that with this 983,116 and then you need to get the difference because the difference is already the discount balance. It's easy, right? Now, at the end of year 1, the undiscounted principal balance will now become 1 million minus 300,000. So, we are going to get an outstanding balance of only 700,000. So, that 700,000, you need to compare that with the carrying amount at the end of year 1. And you need to get the difference, and that's already the discount balance at the end of year 1. And continuing at the end of year 2, the undiscounted balance will now become 300,000 because again, from 1 million, 300,000 was already paid at year 1 and at year 2, 400,000 was already paid. So the remainder or the outstanding balance remaining is only 300,000. So that 300,000 should be compared to this 297,297 and then we need to get the difference and that's the discount already at the end of year 2. Okay? And at the end of year 3, the undiscounted principal balance is zero because everything has already been paid for. At year 1, 300. At year 2, 400. At year 3, 300. So again, the outstanding balance is zero. And you know what? The carrying amount is also zero because again, everything has already been paid for. So it's very logical that the discount is also zero. So that's it for possible question number 6. Now, related to this is the possible question number 7, which is how much is the discount amortized? Well, if you have the discount balances already, then to get the discount amortized, you just have to compare the discount balances. Like for example, the discount amortized for year 1 is the discount balance at the beginning of year 1 minus the discount balance at the end of year 1. And that's it. The same logic applies to the next 2 years. The discount amortized in year 2 is the difference of the discount balance between the end of year 1 and the end of year 2. And finally, the discount amortized for year 3 is the discount balance at the end of year 2 minus the discount at the end of 20x3, which is, I repeat, the discount balance here is already 0. So automatically, the discount balance here, which is 200,000 minus 297,297, will also become the discount amortized. Okay? Question number 8. You can be asked about the journal entries initially, like this one, and the subsequent entries like this. And that's it. If you know how to make entries like this, then you will be able to answer this possible question number 8. However, let me remind you again that sometimes the journal entries of others can be a little bit different. Like instead of this initial entry, their entry will become like this. And as you noticed, there is a discount on notes payable recognized. So that is usually done to keep track of the discount balance and the discount amortized. But then again, even if your entries are as simple as these entries, you can still get the discount balance and the discount amortized as I have shown you earlier. Right? Well, even if you use this complicated entry, if you will be asked how much is the notes payable at the beginning of the year 20x1, you will still answer 983,116 because to get the balance of the notes payable, you need to use this 1 million minus the discount. Okay? So, how about the end of year 1, you say? Normally, in other books, they separate the entry for the interest payment and the principal payment. Like, for the interest payment here at 20x1, at the end of 20x1, the debit is still interest expense, 108,143, the same with this one, but the credit is only 100,000, credit cash, 100,000. Because again, that's the agreed interest payment based on 10% of the outstanding balance, right? So what's the balancing figure, you say? The balancing figure is the discount on notes payable account, and the amount will become 8,143. Okay? So this particular entry, this 8,143, features the discount amortized in year 1. So it's very clear that you can also answer this question number 7 here by making this type of entry, aside of course from the method that I mentioned earlier. Of course, the second entry is for principal payment, which is just debit notes payable and credit cash for 300,000. So there are no complications, right? Now, the entries in year 2 and year 3 are similar to this. So it's up to you to complete those because I assume you understood already. Okay? Now moving forward to the last two possible questions. So the last two possible questions are what is the current and the non-current portion of the liability? And again, to answer those two, step 1, you have to go to the carrying amount that you need to split if ever. Like the balance at the end of year 1, let's choose that. So we have 691,259. Okay? Now, focus on the balance after 1 year. So if we go forward for 1 year, we will have this one, 297,297. That will automatically be the non-current portion because even after 1 year has passed, this balance has not been settled, which is the logic for being a non-current liability, right? Because non-current liability are those liabilities which are not settled within 1 year. So again, this 297,297 will become the non-current portion of the liability of the 691,259. Okay? Now, as to the current portion is the difference between these two. So the decrease from the 691,259 to 297,297. So again, the difference of those two is automatically the current portion. And that's how it is. So those are the possible questions 1 to 10. So let's end this video now to keep this video short. And in the next video, let's already talk about the notes receivable accounting. So thank you for watching and I hope you learned. And if you did, please click like, subscribe, and hit the notification bell to be updated on my next videos.